Yeah, so right now earnings don't look good. Yesterday's earnings were good. Some of the companies that reported yesterday, they actually did well. XM did well. Look how it shot up to 12
Nice.
and settled
Nice.
down here. I mean, because the earning was fantastic, right? But Microsoft's earning and Google's earnings today is just going to hurt the market in the
Yeah.
short term, right? In the short term, right? I don't mean in the long term. So in the short term, it's going to hurt the market. But what we want to do always is just to be prepared, be ahead of the game, and see where could price come to where I am going to take advantage of a movement. That's what we want, right? So when price is driving down, where does it find support? When price is driving up, where does it find resistance? That's all we want to see. And uh, so as we look about uh, analyzing the market, and we're going to go through a couple of charts that you guys might have done as well. When we're looking at uh, the Fibonacci, so remember we start long term. Long term, I said we're in an uptrend, right? This is left to right, the chart is in an uptrend. There's no denying that. However, we have a strong pullback. We're pulling back to that 50% of this move. From COVID low to post COVID high, we are retracing 50% of that move. And where am I expecting price to settle down? At least at the pre-COVID high. That was the all-time high pre-COVID. That's where I expect price to settle down, which is slightly below the 50%. That's where we are right now. And as you know, price doesn't move in one direction month over month, right? It takes a breather. So right now we're in a breather months, breather moment. So from that monthly, when we look at the weekly, I am looking at, hey, here's in an uptrend, here's a downtrend, and so I draw my fib in the downtrend. And as you know, if you recall, if 38.2 is breached, uh, if 38.2 is breached, then I redraw it. If it's breached, I redraw it. That's what I keep doing, right? I just keep redrawing them every time that it's breached, and I keep going to lower time frame. This is my weekly, right? So this is my weekly, and then I go to a lower time frame. In that weekly, the daily is following that. So now the daily is just picking up steam at, where is it at the 38.2. It's kind of hard to see. This is 38.2 from the down move. This move down, that 38.2% retracement of that down move. So that's what it's doing right now. And so when you go to the hourly chart, I have even more precise entry, right? Because the hourly has now given me that signal to where it retraced more than 38.2, and now it's doing this. So this is why it's just such an amazing chart to look at, to see, hey, okay, green to green, right? Always go green to green uh, to validate for an entry point in that continuation. Or if it breaks that 78.6, then we know trend is broken. There's one that I drew earlier that I wanted to. Uh,
I have a quick question. Would you
sure.
um on you see there right there the upward reversal starting the 17th, a little bit before the 17th. Did you draw that as an uptrend?
Would I draw this as an uptrend?
Yeah.
So technically, I wouldn't, right? So technically, I wait for the 78.6 to be breached before I draw the uptrend.
Got it. Okay, yeah. Yeah.
Technically, that's what I would want to see.
Yeah.
There are some instances. I think there's a market, okay, that is showing us uh, too many drawings here. Ooh. Like if you look at, let me just show you. Let me start this drawing for you. Let's look at this drawing. We breached the 78.6, right? So in a downtrend, we were continuously in a downtrend. And we can even start from all the way up here just for the practice purposes, right? We come down, we don't breach the 38, we don't breach it, we don't breach it, right? So if you don't breach it, you're just gonna continue, and that 78.6 is not there, so you don't redraw it. But if you had, for some reason, if you had said, hey, I'm just gonna look at the short term, what it's doing, then you see that in that short term, that 78.6 is breached. Right? This is good as an example. Right? This is not how I would draw it, but it's a good example to show you. In a downtrend, the 78.6 got breached here, and now I am going to draw. I'm going to draw a new one. I don't take this out yet, right? Because I just need some good places for where the uptrend will end, right? I don't have a good pullback, so I can start here. It's been breached. So I can start kind of like this, kind of, because I don't have a pullback to draw to. But like if you had started down here, but it didn't get breached until here, so you wouldn't know, right? So if you come and draw it here, 38.2 is breached. So if you move it up, it's breached here. Then now you just have to move it up, kind of, but we don't know, right? This could keep going up. But as an example, this is a good example. This 78.6 got breached, and then we redraw to the other side, waiting for a pullback to enter. But that's a good example right there.
Thanks, B.
Yeah. So now, so just in general, right now, where the market is sitting is we're in a downtrend, right? There's nothing that has told us this downtrend is over. Remember, in your fib, no matter where, let's find a blank. This blank. Okay. No matter whether you're going up this way, what you're looking for is, as price is driving up, you want it to pull back somewhere between this green to green area, no more than 70% to reverse its direction, right? So what you're trying to do is you're trying to find this area here for an entry, right? So that's what the fib is about. Where is a dynamic support for price to finish its against my expected trend? That move against that expected trend is going to terminate at that some point. Is figuring out that dynamic place where it reverses. So this concept does not change when you're going to the other side. It's the same thing. So remember, you start at 0, right?
Hey,
Up here is 0.
I don't know if it's just on my side, but it's a little hard to hear you.
I can speak louder. Is it better now?
Maybe you can hear him?
It like cuts out. I can hear him, but it cuts out.
Yeah, a little bit. Yeah.
Okay. I hope it's better now.
Now it's like really cutting out.
Yeah.
Really? Is it better now?
Yeah.
Much better?
Yeah.
Okay. All right. So what was I cutting out the whole time or just this time?
No, just that little bit there.
Okay, cool. So should I repeat what I was saying here? Are we good?
Yeah, we're
Okay.
good.
Okay, so remember when you're drawing to the upside, up here is 0% retracement, right? So price has moved here, it has not retraced at all. Then it retraces 23% of this move, 38, 50, 63, and so on to the upside. So that concept does not change when you go to the downside, right? So you draw it this way, price drives down here is 0% retracement, and then 23, 38. So it flips, right? So just keep that in mind. It's how much of this move am I retracing? That's what you're calculating. Right? So in a downtrend, I'm expecting price to drive down, to rally somewhere here to continue my direction. This is the rally point where price reverses that I'm looking for my entry, right? It's like timing the
Yeah,
best.
he just started cutting out again now.
Yeah, I don't know what to tell you. So I'm just gonna keep talking. Hopefully, it will get better.
Yeah, it got better now.
Yeah. Okay. So this is the place where we're trying to find, right? In our 1, 2, 3, in our basic training, we said, hey, we're going to enter down here, but I don't want to wait until here. This is late, right? I want to capture all this move. This is where Fibonacci is helping us, right? Just wanted to make sure that we go over this concept again. I think this is a critical part of the trading, of understanding how Fibonacci works. So we're in a downtrend. We are retracing. We're still below the 70%. We're still below 78.6. So we have no reason to believe that this is over. We're still bearish biased, right? Because of what the charts are telling us. We're still bearish biased. Because of expectations, right? Price is driving down. Expectation is pre-COVID highs. I will be happy if I'm wrong, right? And if price keeps going back and making new highs, even better, right? And so I just say, hey, here's what could happen. So let us prepare for that move. And now we are at a strong resistance area up here. The next time, if once we clear this, right, we could clear this in a couple of ways. We could go like this and then clear it. But I think the next time after we clear that, there's this gap here, we will have a pause as well. But up here, we know we have cleared the 78.6. Once we get up here, now we're anticipating a reversal. It's not 100% guaranteed, right? There's nothing guaranteed, but at least that's what we're anticipating. That's why we're using Fibonacci to prepare us, right? The retracement. That's the retracement piece. So any questions?
No questions for me.
Okay. Anything specific you want to go over before we add more tools? If you guys feel comfortable, I can move on to the next set of tools we will add to Fibonacci.
Yeah,
I'm feeling good. Yeah.
Okay, very good. That's what I like to hear. So the other thing, again, there's another tool called Fibonacci extension, and it's a way to help us predict moves in the same direction. So what I mean by same direction is, I think this is a good example. So this, in this area, let's just assume to the left, we have made analysis and we're going to the upside. Let's just make that assumption. And we're saying here, we're going to the upside. We just want to measure how much of that upside we're going next, right? So the Fibonacci extension tool, which you will grab from here, and you can see all of them here, right? And there's a retracement, and there's that extension. There's retracement and that extension. So you grab that extension and you're measuring. If price has done this move, how much can it go when it has pulled back to here? Look where the price stops. This was not pre-planned. I just picked a random spot. And all you're doing is measuring where can I exit. And when you add that to your regular fib, remember, maybe I should talk about exits a little bit more, is in your fibs, your exits is once you pull back to your green to green and you're heading in the right direction, you have two primary exits and then an exit in the middle. This is not a Fibonacci number, the one in the middle. I just went in between the two. Sometimes price stalls there, so I just want to take an exit. So the negative 27.2% and the negative 61.8. So if you have this as an exit area, and then you add the extension also exits at my midpoint. This is why I like this midpoint. I don't know anybody who uses this midpoint because it's not a fib number, right? So I just created it. I just took the mid of these two retracement exits, and I just said, hey, I'm just going to go in the middle. And that extension also gave us that same middle number there. So now let's just you pick a time frame, and we'll do this exercise again. Just say, look, you got the dates down here, so just pick anything you want.
How about the 16th or 17th?
This move here?
Yeah.
Okay, so this one is a little tricky because we went up here and then we went down here. So here's that exit, right? Boom. So now, ideally, before you drew that, you have already said, hey, I have my fib levels. Where am I exiting? I'm exiting 1, 2, 3, right? Anything above here, don't worry about it, right? Don't lose sleep over exit you've taken early, because price could always reverse, and you preserve capital by taking your exits at the right time, not too prematurely, but at the right exit points, over letting it run, hoping for a home run every time. So when we do this, look, and again, it aligns. This is just another confirmation for you to add. Like, could price go to this level? Has it shown me that it has done that before? Right? Has it shown me from here to here, this move, if it makes the same move, if this, like percentage wise or distance wise, can I repeat this distance again? Yes, I repeat this distance again. To the downside, can I repeat this distance again from here? Boom, right there. This was actually 100% retracement, so you just go back to that original price, but you get the idea. Right? Can I repeat anywhere you go, right? So you go, can I repeat this move? Aha, see? Here's where you've repeated it. but it took a while. These tools are amazing. It all depends how much time you give your trade. When it's this wide, I'll tell you I'm not taking this trade. I'm not taking this trade to exit down here. Right, one, I'm stopped out already by this big move up, even though it went there. Right, but two, I have other exits. So now this exit, how does it align? Right, look, it aligns with my exit one as well. But this is a big move. So if you wait until exit one, you're gonna get hurt. Yeah, when it's this big, sometimes I chicken out and I exit a little early. I call those premature exits, but I save my capital. Like I'm not exiting, I'm not exiting after a dollar move, right? I'm exiting after a significant move. So how do you like this new tool?
We maybe talk a little bit on like the two. I know you just went over it, but the two exit points that you're confirming, like one with the fib retracing and then the confirmation with the extension. I wasn't fully grasping the details there.
I think it's a good question because let's just take this move here. So when you're entering this trade, when price came down to, so when you're entering this trade here, you got your price moved up, it came down, and so you're entering this trade. So it gave you this pullback area, 38.2. So you're comfortable to enter this trade. So you enter this trade. We will talk about entries, right? We haven't talked about entries yet. Entry is a little bit more complex. So that's why I want to dedicate a full day for it, right? So maybe next week we can talk about entries. So we're not talking about entries yet, but let's just assume that you know your entry and you have taken this entry. Where is the logical place to exit? This is where, when you are building your Fibonacci retracement, I'd say, take a screenshot of this. You need these two for your exits. -272, -618. Sometimes you can do 236 or 272, right? The 236 aligns with the 236, so you can do that. I just like to align it with the 1272. Either way, you will not be wrong, but find an exit, right? So here, they're both drawn here. See how close they are? You just pick one. Doesn't matter which one you pick, just pick one. But by all means, your first exit is the first line. Right, you've retraced, you're heading in the right direction, price touches there, right here, that's your exit. You can't. Sorry?
Sorry, go ahead. I was gonna say, is that essentially doubling your money when you're going from 0.328 to -272?
It depends on how much this move was, how much this retracement was, right? So we can't think of it as doubling money. In some instances, yes. In some instances, no.
So why are we taking that at -0.272 then? What's the idea behind that?
So with this, what I have found, with the Fibonacci analysis, is somewhere in this zone, price has a tendency to reverse. That's why we're taking that exit.
Okay,
Now,
so from negative 2.72 to 6.18.
negative 618. Yeah, somewhere in here, price has a tendency to reverse.
Okay.
Now, your idea of double is a fantastic idea, right? Because you want to double your risk when you're entering a position. That's as your exit. That idea still holds because we are not, when we're entering down here, our stop is not here. We're already confident of this position that our stop is somewhere below this swing as we're entering this trade.
Yeah, it's like barely below, right?
Yeah, so it's down here, not down here.
Yeah.
That's what I mean. So your distance, your risk distance is, you're most likely entering this trade at the open of the next day. So your risk distance is 780. It is not 15. That's what I'm saying. So now from your entry though, you need 15. You need 15 from your entry for that double. That double is up here. I'm saying don't wait for that. If you get to negative 27.2 exits, partial position at least, you can exit at least partial position, right? It could be half of your position you exit here, and your stop is tight now, right? So your stop is no longer down here. When you are taking this exit, your stop at the very minimum is at entry or at the high of that entry bar, right? So that's your stop when you're waiting for target 2, target 3 to happen. You have two very critical targets that you have to meet. Number one, the negative 27.2 is your target. That's your price target. You also have a time target. If you're doing options, you have to exit before the option expires. Hopefully before the Wednesday, right? That Monday, Tuesday of that last week of expiration is when you're exiting, hopefully. So you also have that time exit to think about. That's why it's always a good idea. If you're entering this trade was July 19th, was a Tuesday, right? You can see down here the date. You enter this trade on July 19th on the Tuesday. You might go to the following Friday, July 29th. That's your expiration. So when you get exit 1, the very next day, you're very comfortable to just only take 50% position off, and you moved your stop up, right? You have time on your side to wait for that next target. The next target, look at what happens. It hits the next target and it reverses. Twice you just saw. Hit target, reverses. Hit target, reverses. Hit target, reverses. And then it continues. There's a very big chance that when you get to your target, price reverses and it might not come back. Don't take a chance on it coming back, right? If you didn't take your profit here, you didn't take your profit here, and you didn't take your profit here, you're done, right? I mean, that's not how you should trade. 50% is taken off here, another 25% here. Maybe you can take 20% here and let the 5% run for another day because the next day is expiration. But you've already booked so much profit, you don't care about that extra 5%, right? So think about it from that perspective. But you must always exit at a logical place, and you must know what that logical place is. And as you practice, as you play with these charts, you will see, okay, when this happens, it's true, price reverses. You take any random time, and you do your fib. Let's just say you had done it here. The next day, you hit target 1, 2, 3 in the same day. And then you don't wait. And if you keep waiting, hoping that it's going to just go to zero, you've lost your money, because the very next week it had a significant pullback. Right? So you must exit. You must exit. Here, 1, 2, 3. Yes, it went up slightly more, but look, it collapsed. You must exit. Have a strategy. Anything above 1, 2, 3 should be a small percentage of your account. I guarantee you'll make more money exiting at the first exit with all your positions versus hoping that all your positions exit at number 3. Because before number 3 happens, many times that option is going to expire. Right? So be cautious. So now that are we clear on these exits? Negative 0.272 to negative 0.618. This is area where we want to exit.
Essentially, what that means is like a 127, 140, 160% retracement, right?
It's not retracement, right? Because retracement is going this way.
Yeah.
So it goes from 0 the other direction.
Yeah.
That's why it's negative. Right? You're going the opposite way now. You're adding 27%. You're adding 61% to this move. Right? And so now as another tool to confirm, you can use then this extension tool, which will say, hey, you know what? I've made this much move. So if you just measure this move, I've made an $18 move. And if I make that same $18 move, where do I end up? Right there. That's what this is measuring, right? You can measure it, in your head, and you can just kind of calculate it. But this tool just helps you very quickly to see, hey, where could price go? Where could price go? Especially like in a very solid trend, you see it trending continuously. So you see it, okay, it trends. Where can it go? It can go here. It took a while, but it can go here. So you draw it again. What about from here? It can go here. What if this is a move I capture? Where can it go? It can go here. Right? You just keep measuring different areas, like different possibilities. This one is a big move. Right? These big moves, I worry a lot for my exits. Because look, my negative 27.2 comes down here, but so you keep this in mind, this down here. But the extension has said, hey, I need to wait a couple more days. Right? That's why I worry about these big moves. It's just an extra confirmation, but don't rely on it solely. Right? So make sure that your fib is telling you this is where you should exit. After this exit 1. This one aligns with exit 3. So you've taken exit 1, 50% of your position, your stop has moved, and you got stopped out. That's okay, because you're positive on this whole thing.
On the
Yeah.
On the first one you drew right there, can we click on it? The one right there to the right there, the first box.
So
no, the other one.
This one?
Yeah.
Okay.
Yeah. So essentially, like what you're saying is, at the 22.72, that's where you take your first exit.
Yeah.
at 50%, and that aligns with essentially the same move has happened from where you entered.
Yeah, so
Close to where you entered.
Exactly. This line here is just slightly above it.
Yeah.
Right. So somewhere here, when they're close together, you can decide. But I always take the closest to me is my exit, and then I let the rest ride.
Okay.
And then that line aligns with my midpoint, so those two is my second exit, and then this is my third exit. Because we're doing this as on the side, right? We have a day job, we're just looking at charts. I say focus on exit 1, 2, 3. Don't worry about waiting for that extra 5%. By the time you hit negative 618, you should be 100% out of that position, because you don't have time to baby the trade. Like you don't know, like, is it gonna go to the moon, or is it just gonna go $1 in reverse? You don't know, right? So unless you baby it, where would you exit that trade? Because you have no logical place to exit anymore. So you have to be looking at the chart before you can exit. And this tells you, hey, I went up a little bit, but I'm done, so I'm coming back down. So you're actually, instead of exiting here, you're exiting down here. So my recommendation is 50% here, 25 here, 25 here, and you're done. You don't have to look at this chart again until it gives you the next opportunity. You like this tool?
Yeah.
I think it's going to help you.
Yeah.
So your homework will be, I want you to use it. I want you to use it and show me a few for next week.
Okay.
So the way you draw it is in your direction, right? In your direction, you start where a move has happened, where you could potentially enter, and the other side is where your exit is. Right? So that's as simple as that.
Do you want us to draw it on top of the fib, or just this?
Whatever is easiest for you to visualize.
Okay.
Yeah. So that's the tool, right? Here's your tool. You start here. This is the move it made. I'm going to enter here. Here's where I anticipate to exit. And don't delete it because the price didn't reach there. The idea is to know how to draw it. The idea is not to be right all the time, right? Because that's hindsight, right? So when you look forward, you don't have the luxury of seeing where price is going. All you're saying is, if I enter here, I'm expecting price to come down here. Here's my stop, so I got stopped out the next trade. So that's fine. Right? So all the time what you're focusing on is, if I've made an entry, if price has made this move and it gave me this retracement, where does it go? Down here. For now, you just keep it like this. When you add the fib is where you'll have those, see, you have your first exit way up here. So your 50% position is already out. So that's where the fib will help you. But this at least gives you directionally, this is what you can start to expect. But you don't have to wait until you reach there. Especially big moves. On big moves, just, when price gives you somewhere in the middle, you take it, even if you haven't drawn your fib. On the way up, same thing. From here to here, it came back down here. Here is where I can exit. Right? Very easy. And then, visually, you line it up with your fib, exit 1, 2, 3. So they go hand in hand. After you master these two, after you do your homework, if you want to spend more time, we can. If not, the next thing is I want to go into entries for you. I want to show you how to think about entries.
Okay.
I think that's the nice part. And the brain teaser for that. So to my left, I have a chart. It says trading candlesticks. It has different patterns. What's a bullish pattern, a bearish pattern, and I always look at those like as a reminder. So one of my favorites is a hammer. This is why I like to use Japanese candlesticks versus bar charts. Like this is how I started trading in 2005, but I used to love them. I don't know why I love them. Right now they just make zero sense to me. I prefer these ones because then I can see patterns that I can follow. Like here's a hammer. You can read a hammer in this, but you have to be very good at understanding, right? Here's the open, here's the close. They're very close together. That's a hammer.
Yeah.
But if I do it this way, I can actually see a hammer.
Yeah.
Right? I can see an upside down hammer. So a hammer for me, it add a area of value meaning a fib retracement between green to green. Boom, I'm taking the next day at the open. I'm taking this trade. I wish when I take this trade, price to be just slightly above here, because look at this gap from 383 to 386. I missed $3. When you accumulate your profits, and sometimes you take an early trade. By early trade meaning I will come in at 1 p.m. like 5-10 minutes before market close, and if I start to see this hammer, I might enter the trade. I'm not recommending that because it doesn't always work out. I'm just anticipating because I'm in my green zone and I just made a hammer. I'm just saying, hey, you know what? I'm just going to take this. The dangerous part about this is this guy. And this will remind me to talk about gaps because gaps are very important. So here's a gap and we're right at the top of the gap. And the reason why I say it's dangerous is when you take this chance, don't take full position, just take a partial position because price could fill the gap first. Right? So you just take a partial position, you've made enough profits the previous few weeks. You're just going to take, instead of taking your usual 10 contracts, you're just going to do 2 or 3. Right? Instead of doing 100, you just do 10. That's what I mean by a small position. But these gaps are key. You'll see them in my drawings, right? You see them all the time. I always have my gaps drawn. I want to identify where my gaps are.
How far back do you go back for the gaps? Just for that, just reasonably recently?
No, so if you get into the habit of drawing your gaps consistently, like this gap, I had drawn it, but it closed it, so I removed it. Right? All these gaps are closed. All these gaps are
in
closed.
the future. Okay, I see.
Right?
So it comes back to it and it closes. Is what you mean?
Yeah, but let's say this gap here, it could take it 10 years before it closes, right? That's why you leave it there until it's closed. If you get into that habit, and when price is so far away from it, up or down, then you don't have to go back to find it. because it's there for you.
Yeah.
Yeah.
Okay.
But I like those gaps because they remind me where price could stall, could go back and take care of it. See, right here, we gapped up 2-3 days. We closed that gap immediately. We gapped down a few days. We closed that gap. This one came close to closing it. Closing it to me is half the distance. This one didn't quite make half the distance, so it took 2 more days to actually completely close the gap. So now we have a gap down here, and we have a gap up here. This is bonus for today.
Nice.
Nice.
I also wanted to ask you if there's because I was trying to set up my my monthly, weekly, daily fibs, and I wanted to say ask you what's the best way to like save the template, because I can't seem to be able to get it quite right so that it's templatized, so I don't have to like redraw the fib every time. Or I think there's a way you can save it as a template and make it a monthly, weekly, etc.
So you've drawn it first. You draw one.
Yeah.
Then you decide, I want solid lines. These are the colors I want for my daily. Then you come here, template, and you say save as.
Okay.
I don't know if you have that on the free feature.
Okay. And then once you save it, can you edit it, or do you just have to make one again if you want to?
So if I do this, right? If this is, so if I come and make this monthly, for example, I can edit for this one purpose and save okay, but the next time it will still keep that old template. So you have to resave it as a template. Once you make the changes, you can give it the same name.
Okay.
And just,
does it override it if you give it the same name?
Yeah, it'll override.
Okay, nice.
Yeah.
How close do you think we are from being able to test out some of these moves that you've been teaching us?
If you can be disciplined on position size, that's the most critical one, is position size. So if you can be disciplined on position size, I'd say in a couple of weeks you're ready. I think the main thing is we have the tools. We have the main tools to start, right? And the reason why I say position size, discipline is you don't have all the tools yet. You have most of the tools, but you're missing some, right? Like supply zone, demand zone, you need to understand what those mean. If I'm taking a trade, let's see, if I'm taking this, this is not a good example, but let's just say this. If I'm taking this trade down here, and here's my exit 1, 2, 3, and all exit are at the supply zone, I might not even wait for 2 and 3. I might take 100% of my position at exit 1. Because this tells me there could potentially be a very strong sell order. By strong, I mean institutions, not retails. Institution sell orders. Here, as soon as the price touches, it might take it back down. So I don't want to take that risk, because that means, look, if you didn't take profit today, if this wasn't your entry, and you didn't take profit today, I'm out. Today, the position that I took down here, I'm out today. I'm out today because I know this. And you know what? Look at the futures. The futures are telling us we're going to go down. At least That's what I see now. So I am actually happy about my exit. I'm not complaining about my exit. Yes, price could go to fill this gap. It doesn't matter. Right? Rule number one, don't lose money. Rule number two, don't forget rule number one. It's that simple.
Okay.
Yeah.
Nice.
Yeah. So I plagiarize that from Buffett. I like it. Yeah.
Nice. Hey, this is good, Beanie. This is very helpful.
Yeah, you're almost there.
We're gonna have to practice some of this stuff over the next week.
Yeah. You have a trading panel down here. You can tie it to
Yeah.
a practice account.
Yeah, I do on my side.
Yeah, and so what you can do is you can just feel how it works, like not options, but you can just do the stocks and say, hey, you know what? I see this fib retracement. Let me take a trade. You can do that paper trading just to get acquainted with how to place orders.
Is it a third-party app that you connect to the trading panel?
No, you just say, hey, connect paper trade.
Connect the what? Sorry, you cut out, Beanie.
At the bottom, you have a thing that says trading panel. At the bottom of your chart, trading panel.
Yeah, I see it on my side, but it says I have to connect it to a third-party app, I think, is what to be able to display that. Yeah,
It
that's what I
doesn't-
see.
It's your broker, right?
It should
Yeah.
say.
Oh, okay.
Should say. Oh, here it should say trading view paper trading.
Okay. Paper trading.
Yeah. Yeah, so you do that for just to get a feel on how to place orders, but don't get too far ahead. We still have a couple of things to add, and then you'll be able to pull the trigger.
Okay.
Okay.
Any questions before we wrap up?
No, I'm good. Thank you.
Yeah.
Thanks, Benny.